Good morning from London. This is Bloomberg Markets Today. I'm Guy Johnson alongside Kriti Gupta with the cash trade, less than an hour late. Let's tell you what you need to know. Traders are bracing for further fallout as US yields shift higher. Critical US inflation data out tomorrow, but in the next hour, we'll be bringing you CPI numbers out from Spain. Salesforce plunges in extended trading after warning the top-line growth is stalling. We're going to look at the implications for its European rivals. And we're live in Johannesburg as counting gets underway in South Africa. The ANC's 30 years of political dominance is on a knife edge. Kriti.
A quick check on these markets in the meantime. You are seeing them on the back foot here. Euro Stoxx 50 futures continuing in their sell-off, down about 0.4%. The FTSE 100 down about 0.5% as well. But the bond market is getting interesting. That two-year yield, the front end of the Treasury curve, closer and closer to 5%. Meanwhile, Eurodollar 107.91. Markets today starts right now.
Thursday, the 30th of May. Good morning, everybody. We got a lot to talk about, but at the center of the debate around the world in financial markets is this shift higher in yields, particularly at the front end of the US curve that Kriti was just talking about. What are the implications of that for a variety of asset classes? That is what a lot of people are talking about today. This is what Jamie Dimon had to say yesterday about the implications for private credit.
Even I've seen a couple of these deals that were rated by a rating agency, and I have to confess it shocked me what they got rated. So it reminds me a little bit of mortgages. They have not been stress tested. You know, do people really fully understand what I said about interest rates affecting what these things are worth? Do they?
Do they? JP Morgan's CEO, Jamie Dimon, speaking at an industry conference yesterday afternoon. Do they, Kriti? I think we're beginning to talk about the implications of what these higher rates are going to mean.
The cracks that you're starting to see, and the fact that he compared it to mortgages is concerning. That's a giant red flag. It's almost a cry for help for a lot of investors. But I think he's making a really crucial point in private credit and private equity, by the way. Remember, this is where all the funds have been going. If you can't get your yield in the public markets, you go to the private ones. The problem is it's a very illiquid market. So in addition to what Jamie Dimon is saying about the quality of the deals, there's a liquidity, there's a fund flow story here as well, because so much of this money is now parked in these private assets that hedge funds, for example, aren't able to unlock and then deploy in the public ones.
And he's concerned about the retail side of things. He's concerned about, if it does turn, what the retail side of the market's going to be saying, particularly to their congressmen, to their congresswomen, and whether or not they'll be held to pay on that front.
Yeah, it's interesting that we're talking more and more about the retail involvement here in the financial markets. And this is where the ETF story, the passive investment story, we could even throw a little crypto in there if we're feeling it. But it's interesting that this is becoming a more and more of a risk, that the retail base is getting into deals that are not 100% perhaps what they're being made to be in the markets right now.
And this is, he alluded back to 2008, and that will get a lot of people's hairs on the back of their necks standing up. But let's kind of take a step back and think about the wider implications as well. What does this mean for Europe? We're going to get CPI data dropping very shortly out of Spain. You can put your Spanish hat on. We can cover this extensively.
We always
do. we will be. But the German data yesterday, just flagging the risk of inflation here in Europe. Mohamed El-Erian's writing a nice piece this morning talking about the fact that European central banks can't stray too far from the Fed if the Fed's going to be on hold for a long period of time. The market's beginning to digest this idea that rates are going to be higher for longer, and that's going to have massive implications for pricing in a range of assets. We're seeing it in Asian currencies this morning, but there's plenty of other assets we need to look at.
Well, you talked about Asian currencies. The German CPI yesterday driving the euro a little bit lower. You saw sterling off the back of that move against the euro, the strongest going all the way back to August of, I think, 2022. So you saw some interesting moves yesterday as well. To me, what's interesting is that we talk about this narrative in Europe about kind of this weakness, this where's the ECB need to cut. The fact that we're starting to talk about weakness in the States is also interesting, because how much time have we spent on this show and the hours on Bloomberg Television talking about this divergence between the strength in the U.S. versus the weakness in Europe? It feels like that gap may be starting to close. We saw the elements of that in the Beige Book, where they're saying, look, that growth, it's actually flat in a lot of places. You have even big corporates in the States, for example, cutting prices, which never happens.
The Beige Book's been a terrible indicator, though. It's not been the greatest of indicators in terms of how the U.S. economy has performed. It's been really downbeat. It's been beige for really quite some time. and and it hasn't captured this epic growth that the US has seen, this outperformance that the US has seen. Are we on intervention watch this morning for the yen? That was certainly the story when I was coming in first thing this morning. Looks like that story's faded a little bit. But you can just see pockets around the world where higher US yields are really beginning to make people feel nervous.
But there's also dislocations in this market. And over the past couple of days, while you were on your holiday, some of us had to work and had to talk about the euro and the fact that we are still staying at 108 despite soft German CPI, despite, I think, 3 cuts priced for the ECB this year alone, and strategy around how the ECB is going to kind of stem any further weakness in this region. And yet you're still seeing a relatively strong euro. There are dislocations in the FX market that really don't make sense.
Do you want to talk about Salesforce?
I'd love to talk about Salesforce.
Oh my Lord, that is a warning that I think is going to ripple across Europe this morning. It's going to be interesting to see how some of the enterprise stocks here in Europe take that warning and maybe run with it. You've already seen some of the US stocks being marked lower on the back of this. Enterprise software outside of AI doesn't look like it's in a good place this quarter. Even
though it was driving the growth pre-AI, Salesforce was the name to be. It replaced Exxon in the Dow, which I know you don't love to look at the Dow. I love to look at the Dow when it's rebalanced.
Don't look at the Dow.
You should absolutely look at the Dow. Don't listen to Guy. This is important because Salesforce, because it's such a big component, not just of the Dow, but of the NASDAQ, of the S&P 500 as well. The read-through, I think, is interesting, even though 24% of their revenue comes from right here in Europe. So about a quarter of their revenue is right here. I think the question around Salesforce, though, is we have all this investment going to AI. When does it come back? When is the adoption more wide scale? And that's the part where they're saying, look, the sales are still at some of the lowest it's ever been.
Is there a sort of portfolio effect here that people aren't spending on traditional CRM stuff and are instead investing in the AI? But to your point, I think you're asking exactly the right question, which is, at the moment, it seems as if corporates are pulling back. If we start to see them pulling back also on AI and the spend that because they're not getting the return on it, what happens then? Because that will be a massive, we talk about the ripple effect of higher rates. You take the AI story away from these markets as well, that's not going to be a happy place.
But this is my kind of theory, my going theory around NVIDIA as well, right? That the hyperscalers still are having 45% of their revenue in that. That's a liquidity story. They're sitting on record piles of cash. They can't deploy in M&A. They can't really return to shareholders in the same way because of this kind of high-flying stock. There is nowhere else to put it but your R&D, and so much of the R&D goes into the likes of NVIDIA, which then skews the market. And to your point on the rate story, the minute that liquidity crunch happens, the minute there's higher yields, higher inflation, that starts to eat into that cash cushion, there goes your investment.
We're going to watch stocks like SAP this morning very carefully to see exactly how the translation effect works into Europe this morning. Look at some of the other software stocks as well. It'll be interesting to see how Sage trades on the back of this. There are a few names that maybe are going to have an implication off this story that we're going to watch carefully this morning. The other story that kind of caught, I think, a lot of people, not by surprise, but the fact that BHP isn't pushing on with the deal, I thought was interesting yesterday. At a time when everybody's getting so excited about copper, the fact that they've decided not to go down that road, I think, is fascinating. Where else are they going to get their copper from? Where does BHP go now in terms of getting a deal done, I think, is a key question this morning.
Yeah, we're going to bring Will Kennedy on later in the show to give us a little bit more insight to ask those very questions. I thought it was interesting, though, and I'm curious to see how it trades. I think that decision came, I want to say, after market close yesterday. So how does the market react to that? Off the news that BHP wasn't going to have a renewed offer, you did see an initial spike. We broke it, actually, at the top, literally 24 hours ago. I also think what's interesting is what's the read-through into the other miners as well. There was an initial report months ago, I think coming out of Reuters, that Glencore may be interested in Anglo. So I'm curious if this opens the door to other potential bids for those assets.
Let's talk about what's happening in South Africa. I think copper takes us to South Africa and what is happening there. South Africa is such a key part of the story surrounding BHP and Anglo. But let's talk about the politics in South Africa. I think circa 10% of the votes have now been counted after we saw that election yesterday. The country's electoral commission says turnout looks like it's been higher than maybe in previous elections. Let's get the latest from Bloomberg's Jennifer Sabajaja, who joins us now from Johannesburg. Jen, let's talk about how this process is going to unfold. We don't get exit polls in South Africa. Voting looks like it started a little bit late. Where are we in that count, and why did it start so late?
Exactly, Guy. It's important to note really what we saw on Wednesday, late into the night Wednesday, and for some voters even early into the morning on Thursday. And what we're hearing from South Africa's Electoral Commission is that we did see a surge in urban voters. There was a high turnout, as you mentioned, in a lot of urban centers, and potentially even some software glitches is some of the reporting that we're getting. And that's part of the reason why voting started so late. So as you did mention there, just over 10% counted. So still very, very much early days. And when we think about how many polling sites there actually are, over 23,000. And last time I checked, it was just over 2,300 polling sites that had actually been counted. But we're waiting to get some official numbers. And it could take a little bit longer, especially considering what I just said about the polling sites. Also, this was the first time that voters had this 3-ballot system. Many voters saying it was complex. They were waiting in long queues for hours. So, yes, I think it is going to be a little bit longer that we're going to have to wait to get some indication of where the results stand.
Well, talking about the results themselves, talk to us about projections here. Talk to us about what these next couple of days actually looks like when it comes to South Africa.
Right. Kriti, it's important to note that, this voting is really going to be a marathon, not a sprint. And even when we take a look at what we're seeing right now, and I do want to caveat that it is early days, but, we're seeing the ANC potentially having just over 42% of the vote. But that, again, is just with 10% of the national ballots in. And so, many people, investors, voters are going to be waiting to see where these votes are coming in from, because that's going to give us a lot of indication about where these various parties are actually seated in terms of their support. And we're going to need to see a lot more votes coming in to actually get some indication of whether or not the ANC did reach that majority threshold that they need, or they're potentially going to have to join a coalition. And, it's interesting because we've actually been looking at the Rand today because, leading up to this election, we were talking about the best and worst case scenario for investors. We're seeing the Rand slightly weaken this morning. And again, we're unclear really where this final result is going to be, but it looks like investors are potentially a little bit concerned just based on these early results. But, we are going to have to wait and see really where the turnout, how the turnout was, where these results are coming from, and wait until we get those official numbers from the Electoral Commission.
Bloomberg's Jennifer Sabasaja in Johannesburg walking us through what we can expect in the hours and days to come when it comes to those elections. It's interesting that she mentioned the Rand as well, Guy, because this is something that I've been really keen on kind of zooming into, because when you look at the yield story in the context of the broader macro whatever, if you aren't getting yield in U.S. Treasuries, for example, if you're seeing the volatility there, is there appetite to go in the EM space? And I think that has been a little bit of a push and pull as well. South Africa has the highest yield right now in EM debt across the world. Okay.
There's many reasons for that in terms of the risk that the country is running, in terms of what is happening with inflation. Be interesting does that include Turkey? Turkey's yield must be pretty epically high right now.
I haven't looked at that, but I'm assuming.
So what I think is fascinating about the results that are coming out right now is that they're largely urban. So it'd be interesting to see how far the urban skew is going to take maybe the opposition parties in the initial stages of the vote. What happens when you get out into the more rural areas? How does the vote composition change? Maybe investors are reacting this morning to what is happening with that initial read out of the urban areas. And maybe this starts to change as the days go on. But I've been reading, like you and everybody else, a lot of reports recently talking about the kind of the tail risks in this election and how substantial they could be for what is happening with the Rand, with South African yields, and everything else that we're going to be watching so carefully.
And we should mention Yvonne Mahongo from out of Bloomberg Economics yesterday had also made the point that the Rand has been strengthening into this election for about a month. So I'm curious how much of this is just some sort of pullback, taking a little bit of cash off the table before you go into it. We're getting some headlines on the
talk about sneakers?
M&A front. I want to talk about sneakers, yes. I don't own a pair, I have to confess, but I hear they're very fashionable. I own sneakers. I don't own a pair of Golden Goose sneakers. But these are the headlines that are crossing the Bloomberg terminal at the moment. They're planning a primary offering, a size of about 100 million euros, and looking to plan to list in Milan. Now, this is significant. This is, of course, a company that's headquartered in Venice, but it is a luxury company at the end of the day, listing in Milan.
Yeah, it seems like a logical place to list.
It does, but you never really hear that much about Milan listings, I feel like.
No, you don't. It's not one of the major... It hasn't in the past been one of the major listings, and the reason for that has been fairly straightforward, in as much as the luxury space has been largely concentrated and amalgamated in Paris. So you've got the two big luxury groups, particularly LVMH, obviously, but Kering has done quite a lot of the heavy lifting here as well, of basically bringing particularly Italian fashion under a French roof. And as a result of which, you don't, when you think about European luxury, you think more Paris than you think Milan.
Is there a... I'm putting my Guy Johnson hat on here.
You have one of those? Excellent.
I do.
It would
it's
be
in my
highly
back
fashionable.
pocket.
Whether it would list in Paris or Milan, I don't know.
I'm curious, though, if there's a... You always ask about multiples between Europe and the U.S. Is there a multiple story between listings within Europe?
To a certain extent, yes, but obviously the gap isn't as big as we see over in the United States. What I think is interesting is that European luxury trades on a higher multiple than US luxury. It's one of those kind of rare anomalies.
It's fair. It's a...
Well, yeah. We have luxury. Maybe America doesn't.
I don't even have the time to go into that.
OK, let's talk about what else we've got coming up for the rest of the day. It is a busy session. We're going to continue to watch what is happening in South Africa. We've actually got a South African Reserve Bank policy rate decision coming out a little bit later on as well. At 10 a.m. UK time, Euro area confidence surveys come out. European confidence, unemployment, consumer confidence. You're going to get a lot of data. We've got Spanish CPI coming out as well. Informal meeting today taking place in Brussels. NATO ministers are getting together. Actually, I think that's in Prague, that latter meeting, so we'll watch out for that. 1:30 p.m. UK time, initial jobless claims. You get that every Thursday. You get GDP, you get wholesale inventories. New York Fed President John Williams, Dallas Fed President Laurie Logan also speaking a little later on today, Kriti.
Coming up on the program, Saudi Arabia is said to be preparing a $10 billion Aramco share sale in the next few days. We're going to discuss all of the implications. Plus, UBS announces top management changes. Sergio Armati's first major shakeup since the Credit Suisse takeover. We're going to bring you the details there. But up next, it's back to the markets as traders look out for inflation data from Europe and the United States. As always, if you have any questions of your own or for our guests, send them to us. IB plus BBTV Go on your Bloomberg terminal. This is Bloomberg.
Chances of hikes are still fairly low. I think the Fed would prefer to keep policy, in a tight setting for a longer period of time, as opposed to try and tighten things, because they could very quickly and easily lose control of the narrative and of financial conditions if they restarted hikes now. I'd have concern that it would cause a few ructions from a market perspective. Again, equities are pretty significantly over their skis in valuation terms, particularly in the US.
James Anthony, fixed income portfolio manager at Marlborough Investment Management, talking to Bloomberg TV earlier, reflecting some of the concerns that are in the market right now, reflecting concerns about where rates are. They may not go higher from here, but they look like they're going to stay higher for longer. And what does that mean? Joining us now to discuss this further, Haig Bathgate, Head of Investments at Atomos. Morning.
Morning.
We also had Jamie Dimon overnight, voicing some concerns about what higher yields are going to mean. He was talking about private credit, but he was just talking about valuations and whether or not the market's got its head around what these higher for longer yields are ultimately going to mean. Do you think it has?
Yeah, look, I think the longer that rates remain high, the more likelihood there is of this slipping into some sort of credit event. And we see this, the Fed have been very clear, and you see every single print and every single update you get from them. They're going to wait for confirmation before they do anything. We saw this in the way into the rate hike cycle. They were asleep at the wheel and very slow to react. And they're going to wait for the confirmation on the other side. So the risk is obviously the longer this goes, we've got, I think it's half of the European high-yield market refinancing it next year. We've got 20%.
OK, so where do I look for the cracks? If we are, it looks like the summer's going to be a period in which maybe the Fed just waits and watches the data, and maybe we start to think about this again in the autumn. If we're working our way through the summer, where am I looking for cracks if they're going to appear?
Yeah, so I think it's the refinancing of high-yield markets in particular. I mean, there's not so much of that coming through next year, but the market obviously will start to look at this half a year in advance.
Yep.
Private equity sector, I mean, I know lots of people are talking about that now, but that is the one area. We know if you go way back to 2009, a lot of the shadow banking sector stuff started then. A lot of stuff that was being done, traditionally on bank balance sheets and through banks has now gone off balance sheet into the shadow banking system. That's never had a moment of reconciliation.
How do you hedge the cracks, though? So if you see them appear over the summer, how do you hedge it?
Yeah, well, I think this is an interesting thing, isn't it? In high yield, you could argue you are being compensated if you've got enough diversification. But again, this is the kind of environment where you get unexpected things happening. If you go back, WorldCom, Tyco, Enron, these things tend to happen after you've had sort of 10 plus years, of a pretty benign economic environment. Of course, this will then feed into the rate cycle. If we have something like that happening, then obviously you would expect rates to be cut quite quickly. But I think you have to be really, really careful with the credit risk that you're running in this environment.
But what are defaults going to look like? This is what a lot of credit managers will say. Yeah, we're going to get some defaults. Yeah, things are going to pick up. Yes, things are going to be tough for certain companies. But in aggregate, actually, the default cycle is going to be relatively low. My recovery rates are going to be reasonably high. We're going to be okay. We'll take the hit. But actually, to your point, with the yields on offer at the moment, they're worth taking.
Yeah, well, that's the problem, isn't it? Or the advantage you have at the moment. You get so much of a high yield now on a conventional government bond, and they're rising. Obviously, we saw another auction issue yesterday in terms of yields appreciating. How much additional yield do you have to get to take on the potential risk of the default cycle? I think particularly around investment grade, the spreads are still wafer thin. They haven't moved out in line with interest rates.
What does that delay look like, though? So if we're talking about this higher for longer policy, we're talking about these cracks appear. What do we pay attention to? Do we pay attention to allocation from global Wall Street, or do we pay attention to the underlying consumer data?
Yeah, so I think there's different. So bond refinancing, we'll start to see that come through. So we have to see. We're obviously starting to see a bit of a shaky environment in the government bond market. How does that manifest itself into corporate bond world? I mean, there's obviously lots of assets that are parked there on a semi-permanent basis. So do we start to see companies having difficulty refinancing? Do we see the rates that they're having to refinance moving much higher? Or do we just start to see defaults pick up? There's usually a pattern with these things. Something will happen somewhere and then it'll have some unintended sort of consequence.
So it kind of sounds like you're basically saying this kind of zombification of the economy that we were fearing is actually what's happening in the background.
Yeah, I think so. I think the shadow banking sector, nobody really knows how big the shadow banking sector is. Nobody really knows what's in it.
Yeah.
Nobody knows. And look, we're starting to see this with private equity world. We're not seeing too many IPOs. Is that because they're not getting the valuation on the IPOs?
Yep.
All this stuff is interrelated and feeds back.
When it comes to the capital markets activity that you were just talking about, though, is that what we need, though, to keep the music running, keep the party going?
Yeah, well, this is like the double bluff, isn't it? I mean, every time this has happened in the past, there'll be some sort of tremor and then the Fed will come to the rescue. I suppose where it was different, and if we look back the last time we had a not dissimilar to event, what we're going through at the moment, it was the GFC, and that's when you have moral hazard. Do you bail out a sector that's over-levered, that has, isn't necessarily doing better good for the...
Is the Fed still going to come to the rescue with inflation this high?
Yeah.
I think if inflation can drop off pretty quickly, if the credit markets dry up, I mean, look, you can see all the figures. The COVID savings are being depleted. We saw the Beige report last night, didn't really say much other than we're starting to see demand destruction at the margin. This stuff can manifest itself in confidence figures pretty quickly.
I think you just named all of the traumatic events for our viewers in one going. We appreciate that. Haig Bathgate, Head of Investments over at Adamas, joining us this morning, walking us through some of the things that we're keeping an eye on, Guy.
Jamie Dimon's talking about mortgages. That when Jamie Dimon starts saying, "Oh, there's a few things that are kind of comparing and contrasting in my mind with what we saw in 2008 with the mortgage crisis," you want to sit up and pay attention. Now he's been quite downbeat for a while, but that's concerning.
Well, Haig would argue, well, Jamie Dimon started it, and so he had to continue it. Coming up on the program, we go a little bit more international here. Saudi Arabia is said to be launching a $10 billion Aramco offer. Bloomberg understands it could happen as soon as Sunday. We're going to dive into that scoop next. This is Bloomberg. Welcome back to Markets Today. We're about 30 minutes away from the start of today's trade. You are seeing futures a little bit on the back foot here. How much of that is just kind of a hangover from yesterday as well? How much of it is actual worries about a crack in the system? I think what's interesting is there's a really interesting cross-asset trade happening right now, Guy, where we're talking about the yield picture. Two-year yields getting very scarily close to 5% off some of the monetary policy narrative. That's pushing the dollar higher. That's weighing on commodities. And you can see that on a really fun chart on my launch pad here. Gold, copper, oil, all turning lower, tick by tick.
Yeah, it's because they haven't all traded together recently, which I think is fascinating as well. Because the gold story has been very different to the oil story. The story that really caught my eye overnight was the GOP warning Biden not to tap the SPR again, because gas prices are rising. We're into the driving season.
Yeah.
People are obviously going to feel that, and then they're going to park that story when it comes to they're going to park that story at kind of his door when we come to the election. The GOP's like, don't do that. Don't use the SPR as a political tool. I wonder how big a temptation it's going to be and what the implications of that would be.
That's hilarious, because that's what the SPR has turned into.
Well, no, precisely. It's not meant to be there. But it has become that kind of, if gas prices rise too far, this is what we do. It's not there for kind of 1973 and the oil crisis, and that's what it was originally conceived for. It feels like it's become a much more micromanaged kind of a process, and maybe with a bigger political overlay.
Yeah, that's a very good point. Well, let's go from one player in the oil space to another. Bloomberg has learned that Saudi Arabia preparing to formally launch a secondary offering of shares in oil giant Aramco as soon as Sunday. The sale could raise over $10 billion. Let's bring in Bloomberg's Matthew Martin joining us this morning out of Riyadh. Matthew, walk us through why the Saudi government is launching this offering now.
Good morning. Yeah, well, look, 5 years on from Aramco's IPO, where they raised $30 billion. Now they're coming back to the market looking to sell more stock in Aramco. This comes at a time when the government is facing a lot of constraints around its cash. It's committed to a whole host of these ginormous projects all around the country, as well as international investments that are being done by the Sovereign Wealth Fund. And it's increasingly coming to the realization that it's maybe stretched itself a bit thin, and so some of these things are having to be pulled back. And in that context, I think we see Aramco now coming out, or the government now coming out and looking to sell another stake in Aramco, looking to raise $10 billion and then use that and probably leverage it to reinvest back into the Saudi economy. It's not a sort of right now is perhaps not a great time to do it. Aramco's stock is at the lowest that it's been in the past year, but part of that is this overhang because everybody's been expecting this offering to come out, and so that's been depressing the price over the past few months.
Let's just talk a little bit about who's going to buy it. Last time around, it was mainly pushed out to the region. A lot of GCC money went into this. This time around, do they do that again? Is that how this works? Because the question I think a lot of international investors may ask is, why do I want to buy this stock, which still trades on a pretty punchy multiple, versus some of the big oil majors, which trade on multiples that are significantly lower?
Yeah, I think this is going to be the big challenge for them next week when this offering formally launches. From what we understand from sources, they have been out speaking to investors already. They've got pretty good indications of demand from the region and from some international sources as well. But I think, as you say, the big problem they had in the IPO was that, or even at the valuation then, which listed at around 32 riyals a share and close to a $2 trillion valuation, a lot of big international investors thought that it was overvalued. The price of Aramco has come off a little bit. This will be sold at a discount, so it will give you some. It will give you, if you are interested in Aramco, this is a nice entry point. And there's probably a lot of funds out there who, because of the MSCI weighting and tracking, will probably have to go into this is a good way of getting access to Aramco at a discount. But I think for sort of a big strategic investment, this is exactly the same problems that they had in the IPO in 2019. That where is your long-term growth story, and how does it compare to some of the other big oil majors, which offer some more attractive valuation multiples?
Great story, though. Great story. Matthew, thank you very much indeed. Matthew Martin joining us out of Riyadh on what we're going to see over the next few days from Aramco. Let's talk about a different commodity and what is happening in the copper space. After 5 weeks, a 5-week public battle between two of the biggest names in the copper market, BHP has abandoned its $49 billion bid for Anglo American. The deal would have significantly increased BHP's copper production at a time when we're all worrying about what is going to happen with supply of this critical metal for electrification. Let's bring in Will Kennedy, Bloomberg Senior Executive Editor for Energy and Commodities, to talk more about this. OK, so it hasn't happened. Where does BHP go now for its copper that it clearly wants? And where could it look potentially for that copper?
Well, BHP today will take plaudits for its discipline. You know, when you spoke to BHP shareholders, they said, we like the rationale for this deal, but mining majors have messed up an M&A before, and our overriding concern is that doesn't happen again. So they will walk away from this saying, look, we're trying to do good things for the business, but not at any price. So that's their story today. You're right to identify the fact that they would still like to reweight the portfolio away from iron ore, more towards copper, and they don't have the best copper growth story in their existing assets. So the question will come back. We don't know, but they're only out of this for 6 months.
That's the BHP side. On the Anglo side, does this open the door to other suitors for Anglo?
I think, who knows, possibly. I think all eyes are on Anglo now. Anglo, to defend this bid, put forward a very bold, quick restructuring plan, which requires the management team to do an enormous amount in a very short period of time, get out of one of its big South African businesses, Amplats, platinum mining, put De Beers up for sale, pull back from a big mine for fertiliser in northern England, and sell some metal coal assets in Australia. This is a lot to do. And people are really going to be asked, is it possible? And if it doesn't happen quickly enough and the share price doesn't rise fast enough, then of course people are going to be seeing Anglo in play. And I don't think this story has gone away forever.
So they're really caught between a rock and a hard place here. If they deliver on the deal, if they deliver on what they've laid out, they look like a takeover target. That's the problem. You strip away all the hard stuff and the copper kind of is right there for the taking. But on the other hand, if they don't do it fast enough, the market's going to go, OK, well, somebody else is going to come in and take you over anyway.
One of the interesting aspects of this story, of course, is that to defend against BHP's advances, they had to make themselves look like the company BHP had pitched. And so you're exactly right. It will be a leaner, more copper-focused company. And that, in the world that we're all describing of growing copper demand, electrification, AI, will look like a very, very juicy target. So it's going to be a fascinating story to come. You know, there's often a bit of deflation. Oh, my God, this big deal doesn't happen. You know, what a shame.
It's not over yet.
But this will remain a very, very interesting story.
Connect the dots then for us from the macro story. If we're talking about these kind of short squeezes, basically, in copper, how does that affect the valuation then of Anglo? Does it only go up from here?
Well, that will depend ultimately on two things, the copper price, and there are a lot of people who are bullish about the copper price, certainly in the medium term, although actually supply and demand looks reasonably well balanced right now. But yes, in the medium term, very people are excited about copper, and it will depend on Anglo American's operational performance. One of the reasons that BHP took this opportunity is because it had problems in its copper mines, and its earnings are disappointed as a result. So it needs to sort those issues out as well. But yes, if you mine a lot of copper, the outlook is pretty good.
Can I join a few dots? Some of the stories we're covering here on the show this morning. We started off the show talking to Jen down in Johannesburg, talking about the South African election. We don't know kind of how that's going to turn out. There are some quite significant tail risks in some of the parties that could come into power. How big a factor could South African politics be in Anglo's ability to execute on the plan that it has put forward?
Well, Anglo's argument all along was we know South Africa, we're in South Africa, we have a strong South African heritage, so we can get some of these things done in terms of the demerger of Amplats, for example, in the way that BHP couldn't. And that may well be true. I do think one of the problems that BHP had in this bid is that it became public at a time in the run-up to South African elections, and that was less than ideal for them. Post-election, it may be easier, depending what the election result is, to have some of these conversations about whether those two companies, Amplats and Kumba Iron Ore, need to be part of Anglo forever.
There's a threat of nationalization broadly in miners at the moment in South Africa. How aggressively does that apply?
I don't think that anyone thinks these companies are going to be nationalised right now, but of course, politically, it's desperately important to protect jobs and to protect the future of these companies as South African companies, and I do think that will be a priority for whoever wins the election in South Africa.
All right, Bloomberg's Will Kennedy. Rapid fire round at BHP Anglo this morning. We thank you so much for bringing that to our show. Coming up on the program, we're going to get to your stocks to watch, including SAP, after Salesforce sunk in U.S. trading with the news of second quarter revenue outlook that not only missed estimates, maybe the lowest numbers or close to the lowest numbers in its history. We're going to talk about the read-through. Stick with us. This is Bloomberg.
If you look at PMIs just recently, they're still in contractory mode, but I think they're increasing. That has also driven the euro a bit higher. So from our point of view, I think that could continue.
What's particularly encouraging is that activity data is holding up okay, even as inflation is slowing. So the ECB will view that as a positive. In terms of whether it'll reflect in the currency, we think a lot's already in the price. And from here, we're not bullish on the euro, largely because the euro lacks the yield to continue to appreciate against the dollar.
The euro has remained quite resilient. And I think that's largely because the economy has been turning around the corner. That being said, it's very unlikely for the euro to hold that strength in the face of a much stronger dollar, given the fact, as you pointed out, Kriti, much stronger economic data coming out of the US in comparison to the rest of the world.
Some of our guests this week on their outlook on the euro, and Guy, you can already see it. There's a little bit of division here. Christian Nolting was the contrarian, saying that he's actually bullish on the euro.
Well, he's taking it from the point of view of the data, and the data are getting better. The problem is, though, they're not getting as much better as what we're seeing out of the United States, where the data looks okay. I'll take the beige book with a pinch of salt, but it's the difference between the two that I think is the interesting trade at the moment, and has been for quite some time. You look at what Mohamed El-Erian's writing about in the FT this morning, saying that maybe actually European central banks can't go as far as maybe they would like because of the fact that the Fed is not going to go at all, potentially. And it's the relative trade here that is so interesting in terms of the implications of higher yields in the United States for the rest of the world. Our currency, your problem. Our yields, definitely your problem.
You love that phrase.
It's a good phrase. And I think it's really relevant at the moment.
It is. And I think the question seems to be, regardless of what currency pair you look at, when is this going to break? When is this going to snap? When is it going to actually reflect the fundamentals? And that was the exact question I asked to Christian Nolting. Why is 108 euro dollar make sense right now? And he said it doesn't. But we're still bullish.
But that's where we are.
Yeah.
Exactly. Let's carry on the conversation. Bring in Markets Live Executive Editor Mark Cudmore. Mark, the world is waking up to this idea that we're going to see higher US yields, and there's going to be big implications, and that's going to last for a while. Should we be scared? Should assets, should investors, should portfolio managers this morning, how scared should they be of higher for longer US yields?
They shouldn't be overly scared. This is a dynamic we've talked about a lot this year, Guy, that why was the market so obsessed with cuts unless you're predicting a rapid growth slowdown? The inflation story, growth story has not advocated or not supported the idea of cuts from the Fed this year. And we've talked a lot about the idea that hikes need to be considered. It doesn't mean that hikes are suddenly the base case, but we need to be pricing relatively neutral moves on rates and kind of really be data dependent. And at the moment, growth is holding up okay and inflation is staying sticky, which might even argue the next move might be a hike. But who knows? We're still uncertain on that idea. Why should it not be a problem? It's because it's generally the economy is holding up. Rates are higher for positive reasons. That's ultimately good for equities. In the short term, they're suffering from repricing because they lived in this kind of dreamland that, hey, growth's going to be perfect, yet we're going to get loads of rate cuts. No, you can't have both worlds. You can either have good growth and higher rates, or you can get soggy growth and lower rates, but you can't have the best of both worlds. So equities are having a little bit of repricing. It might last for a couple of weeks, maybe not, but overall, for the next few months, equities will go higher.
Mark, we're all obsessed with the fact that this is a Fed story. Is it a Fed story? I look at these I've been off for a couple of days. I looked at these auctions. They're not failed auctions. They are weak auctions that we've seen out of the United States. That's where the concern maybe is starting to come from now. This isn't about the Fed. This isn't about the ECB. This isn't about the Bank of England. This is about fiscal policy in the United States.
Yeah, it's a very good question. I didn't expect the auctions this week to have such an impact, and they did. I think it is a Fed and fiscal policy story. They're just different time spans depending how they're working. It's not even just a US rate story. It's a global rate story. But obviously the Fed is the most important central bank. Fed monetary policy is the most important. And it's fiscal policy in the US that people are most worried about because we're going to a presidential election. And it doesn't seem like either side is particularly enthusiastic about being fiscally responsible. So a ballooning fiscal situation is likely to only get worse. That's going to keep the ramp up on inflation and going to keep that pressure, upward pressure on yields for the long term.
All right, Mark, don't go anywhere yet because I know we're talking a lot about yields. We should go back to the FX space as well because that feels like is where it's translating. There's a chart that caught my eye here. When we're looking specifically at the Japanese yen, we haven't talked about this for a couple of days, so it's good to bring it back, especially when dollar yen briefly touched some of those intervention levels, or at least alleged intervention levels, back on May 1st. Now, it's been, we'll count, 29 days since that's happened. And Mark, this is what that chart really shows, is kind of this almost U-turn that we've made in that currency pair. Mark, I want to bring you back in here. Talk to us about where the thinking is around Japanese assets right now. Does it still kind of work as a hedge? Are people still scared about it? What are you hearing?
So people are worried about yen intervention. We're certainly seeing speculation out there. In reality, I think most people are watching it most closely, don't expect imminent yen intervention. The pace of this month of yen declines has been much more gradual. We're only back to the level we were before, and pace is a very important part of the dynamic here. It's also got to be quite depressing for Japanese policymakers that they spent an estimated $70 billion worth of yen intervening, and we're right back at those levels. And it's unlikely they're going to want to fight the narrative in a world where US yields are going higher. It's also probably quite depressing for them that the fact that Japanese yields are rising more rapidly, and closing that gap, it's still a vast gap with US rates, isn't doing much to help the yen. I remain in the camp that very bearish the yen, and there might be bouts of intervention, but those bouts of intervention, as we said for the last month for the intervention, will be used as a chance to resell the yen at better levels. So sure, as dollar yen drifts higher from here, people are going to be more nervous. There'll be some twitchy trading. I can see if we get a strong data out of the US tomorrow, seeing yields jump again, then I could see suddenly people panicking if we get a move in dollar yen that is intervention. But ultimately, dollar yen intervention will not work while the fundamentals remain so bearish for the yen.
Mark, great stuff. Thank you very much indeed. Bloomberg's Market Live editor, Mark Cudmore. Remember, you can get Mark, the rest of the team, their views, what's happening in these markets, a real-time blog, MLIV Go on your Bloomberg. Kriti, we need to talk about South Africa. We need to talk about what's happening. The rand, it's pushing lower. It looks like the ANC, we're early in the count, but it looks like the ANC might be about to lose its majority.
Yeah, maybe winning 41.5% of the vote. The CSIR model, showing the MK party winning about 13% of the vote, we'll call it. And you are, of course, seeing the FX space. The coalition government, we should remind our audience, was a little bit of a concern from a business perspective. Yep. One, because it makes policy trickier to pass in terms of legislation, but also because there was that threat of, do you have a little bit more of a central government, a little bit less of business-friendly policies, and that might be, again, tricky with a coalition government.
It's amazing. Since the mid-90s, South Africa has been ruled by the ANC. Obviously, There's been a few bumps along the way, quite significant ones. This is a huge moment in the post-apartheid era that we now see potentially the ANC having to form a coalition with some of its smaller rivals. We'll keep you on top of that story as we work our way through the morning and through that count. Let's return now, though, to what is happening with some of the single stock stories we're watching in advance of the European equity market open. Joe Easton has all the details.
So we're going to be keeping a close eye on the software stocks here in Europe today, Guy, given that massive drop that we saw in Salesforce shares after the close, following the worst bookings in the company's history in terms of the quarterly growth. There it is on the screen, down 16%, a huge drop for that company. And there was a good quote out of an analyst from KeyBank that we're going to bring up. Jackson Ader is his name, and he had this quote: by seemingly any metric, the quarterly growth was a disappointment, and the margin upside story that many were hanging their hats on chose to take the first quarter off. So that margin upside didn't come through. That's also what people were looking for alongside the growth. So we're going to be watching SAP, the biggest cloud company in Europe, and also companies that specifically do technologies helping firms with things like HR, accounts and sales as well. So Softcat and Sage in the UK stand out to me, and Capgemini, which is a massive firm in France. All of those could potentially be impacted today. Then we're also looking at renewable energy. We've got Neon now. Brookfield, the massive Canadian money manager, is buying a stake in this company. We've got the details on the screen. It's a 53% stake in the firm. And once they've done this, they also plan to do a tender offer for the rest of the shares and take the company fully private, according to Bloomberg sources. Now, the price of the stake purchase today is $39.85 a share, a 27% premium almost to where we closed yesterday. So we would expect to see a gain in this stock. It's had a bit of a volatile 1 year. It's up around 10%, but we can see up and down. But if we take it back further over a long-term chart, we can see that it's actually well away from where it was back in its pandemic peak. So people might actually see this as quite a good price to be getting into this stock. Maybe we might see a bit of a read across in some peers in the renewable space today as well. Going the other way, though, we're expecting to see Pirelli fall over in Italy. This is as one of its biggest shareholders offloads a large amount of stock. This is China's Silk Road Fund, selling 9% of the company for 512 million euros. It's a big old stake sale today. Italy is trying to limit China's influence over strategic assets, and Pirelli does fall into that under the PM, Giorgia Meloni, so potentially a bit of pressure there. Now, with this one, priced at 569 euros, it's 8.1% discount from the last close almost, so we would expect to see downside. We can see it having a decent run, given it's reported some pretty strong earnings recently, but I would expect Pirelli to be a weak one over in Milan today.
All right, Joe Easton there with our equity story. We thank you so much for those stocks to watch. A quick check, though, on the rand that's continuing to weaken off those projections in South Africa. The vote is still early. The tallies are still early, but it looks like early indications say that the ANC may win about 41.5% of the vote, potentially setting itself up for a coalition government. On the meantime, you are seeing the 10-year in South Africa higher by about 13 basis points, now 14, and climbing as we speak. Coming up, it is the market open. We're going to talk about the read-through from BHP, Anglo, some of the stocks that Joe was just walking us through as well. Plus, of course, the read-through from Salesforce over in the States. That conversation next. This is Bloomberg. Welcome back to Markets Today. Just a few minutes to go until the start of cash equity trading in Europe. You are seeing futures a little bit lower here. Is this perhaps a hangover from what you saw in the States? This is the second day that you're seeing a sell-off here. We're watching our eye on a couple of individual movers. The read-through from Salesforce is a big one.
That's the big story this morning, isn't it? It has to be. Let's see what happens with Atos this morning. Let's see what happens with Sage. SAP, also the big one out of Germany, to see what the implication of that is going to be. That was a huge drop after hours for Salesforce. These quarterly numbers look pretty devastating, and this has been a sector that has been so critical to this ascent that we've seen in US markets, enterprise software. Increasingly, it's been transferred maybe into the sort of enterprise AI software universe. But this is a big effect globally on a sector that Salesforce does a lot of business over here in Europe. You wonder what's happening with their customers that we're not seeing maybe this pickup as well. There's loads of ways to read this story.
There are. So about a quarter of the revenue coming out of Europe. I think about 50 or 60% out of the States, of course. 16% drop in extended trading, to your point. Even though the revenue is still up by 8%, this to me, I'm having a little bit of a Microsoft deja vu story where you have these massive companies that are growing at enormous numbers. You love to talk about multiples. Salesforce 100% trading at very, very high multiples as well. The read-through is interesting, though, because it's still growth, and it's still very fast growth.
It is,
but it's just not as fast
But the market's taken... These stocks, we talk about tech stocks being priced for perfection. They are priced for perfection. You get any kind of a miss, and the market is reacting really violently to that.
The business investment is crucial. It also can be, when you start to see these cracks in some of the business investment from the likes of Salesforce, et cetera, it can be, big emphasis on can, an indication of the broader economy, and that has been seen in Amazon, Microsoft, Apple, et cetera. So it looks like the markets are officially open here. When you look at the FTSE 100, we're still waiting for some of those trades coming in slightly lower, as futures had indicated. We're still waiting for some of those trades to shake out.
A few markets closed today. We've also got a few ex-dividends as well. I see Volkswagen at the bottom of my screen. Volkswagen has gone XD today, so just bear that in mind in terms of what you are seeing. I want to get SAP up on my screen to see. I imagine it's going to be a struggle to get this stock open this morning, but let's see how long it takes to get this stock open and exactly what we are going to see. Now, it was tracking lower into the close yesterday. So we'll see what happens when it opens this morning. But it could take, I suspect, a little while to get some of these software stocks open this morning.
But right out of the gate, if we're talking about the big tech trade, the heavyweight tech trade, which of course you don't love to talk about the Dow, but I do. The Salesforce is a big component of the Dow, and as well as the S&P 500 and the NASDAQ as well. ASML is still one of your biggest laggards this morning, and it's one of your biggest heavyweights as well. We should talk about some of the other sectors. You mentioned Volkswagen taking a little bit of a hit. Your commodities names on the back foot right out of the gates.
Yeah, like Volkswagen's down for technical reasons. There's nothing other than the fact that there's a dividend. But there's only one sector, as far as I can see on the screen behind you, that is positive this morning. People are looking maybe for a little bit of safety today. It's interesting that the food and drink sector is down a little bit. You're starting to get some other sectors beginning to open up a little bit now. There feels like definitely a safety trade on here in Europe this morning. Health is doing okay. Consumer staples are doing okay. The insurance sector is doing okay as well. Those are the only areas that you're seeing really any strength this morning in terms of where stocks are pricing. So definitely the market looks like it's seeking a little bit of safety right now.
We should get a quick check on Anglo American as well. Those shares down almost 3% on the day in the fallout of this.
That's not a big move, though, to the downside, do you not think? In some ways, if you kind of pull the rug of a massive M&A deal out from under this business, maybe you get more. But to Will Kennedy's point a little bit earlier on, maybe
the story isn't over. There's a comeback in the works.
Well, precisely. We're not done with this story yet. I'm still waiting for SAP to open. The Salesforce read across is, I think, going to be really critical to seeing how Europe trades as well today. Should we talk about the economic data?
Let's do it. This is my favorite topic,
This is Spain.
This is Spain, except this time I can't take any credit because the holidays passed. So
data is rearview mirror. So maybe this is May data.
Maybe I did help out with the Spanish economy. Spanish preliminary May harmonized CPI rising 3.8% on a year-over-year basis. The estimate was 3.7%. Remember, this comes off the heels of the weak German numbers that we got yesterday as well. So again, it's a tale of two economies, or I should say 27 in Europe as well. But you can really see that the periphery continues to be a little bit hotter than the core.
So it's interesting, the yields are rolling over a little bit. We saw a big move to the upside yesterday. That obviously got a lot of people spooked. The fact that we've had a series of auctions in the States that really kind of concern so many people starting to ripple around the world. And we've seen the effects of that in the Asian trading this morning. But we're seeing a little bit of a bid coming back into bonds this morning too.
We are. And I'm curious how much of that is just kind of a function of the risk-off sentiment that you were seeing across the board. When you look at stocks, when we look at commodities as well, that just automatically create a bid into the bond market as well. Let's get a little bit more analysis. Maybe this is the reason. Joining us this morning, Kareem Shadid, head of EMEA investment strategy over at BlackRock. A pleasure to have you on the program. Someone tells me it's your birthday. Happy birthday.
Thank you.
We appreciate you spending it with us. I don't know what you were thinking.
I don't know.
We didn't get you anything. We're so sorry.
I can't think of a better plan.
Okay.
Walk us through what you're making of this bond market. We're talking about cracks. We're talking about monetary policy, these divisions. There's a lot of rhetoric here from various officials. What do you do with this bond market?
I mean, as you're highlighting, obviously we had the weak auction yesterday, and there's a bit of this sentiment around an expectation that demand is a little bit weaker, inflation is perhaps not slowing down as quickly as expected, and that's created this environment which is pushing back rate cut expectations. This hasn't started this week. This has been a theme with us for quite some time. We started the year with 7 cuts priced for the Fed. We're now at less than 2. The way that we look at this is through being more targeted in our duration view. So we like to stick with the front end of the curve when it comes to U.S. Treasuries and the belly, so up to the 7-year tenor. We see that as the area where you're still getting the most bang for buck in terms of income for stability. So up in quality with good income. In Europe, a little bit more duration risk taking.
Okay. Pause that thought for 1 second. I'm going to get a quick check on SAP as well, because those shares are moving down almost 3%. We were waiting for that read-through from Salesforce, those opening numbers coming out. We're going to have a quick sector check for you in just a few minutes. But Kareem, let's connect those dots, though. When you look at this equity market and you look at the bond market, there was an era, I'm old enough to remember that there was an era where higher yields immediately meant you sell tech. It feels like that inverse correlation has faded since. How do you connect the two? Or don't?
Actually, you can connect them through earnings. We've just wrapped up the earnings season. U.S. earnings have been doing pretty well. Here's a stat. If you look at earnings outside of Magnificent 7 in the U.S., you're down 2% on the quarter in terms of growth, year on year for the quarter. With Mag 7, you're up double digit. So that tech earnings drive is still coming through quite strongly. And those fundamentals are driving the tech shares higher. So we still like the tech sector. It's one of our key sector overweights. And it's driven by fundamentals.
Is that going to be enough to continue to lift the market, though? That's the critical thing. You've got a lot of good news priced into that sector. We're just seeing Salesforce as an example maybe of what happens when you miss and don't give the market what it wants when you are traded at such lofty multiples. Are the multiples so high now that we're going to struggle to move the market forward? How do you get this market to go higher from here?
Yeah, I mean, there's certainly some dispersion within the sector. Some names are doing a lot better than others. But when that's something also clients have been positioning for. So we've started to see, to your point around what else other than tech, we've started to see a trend into European equities, into Japanese equities. Europe, for example, looking at ETF flow data, has had $10 billion of buying this year, which is the largest inflow year since 2021. And 2.5 billion of that, so a quarter, is coming from U.S. investors. So it's not entirely, in its entirety, domestic. It's not just European home bias. There is some foreign investor trend coming into this. And obviously, Europe is not really tech tilted, so it's the other side of the coin. So that's an area that we're
How fragile do you think that sentiment is? How fragile, how quickly could that reverse?
Yeah, I mean, I think it's driven by three things. The ECB, obviously, we have the inflation number tomorrow, and we're expecting the ECB to potentially move in June. It's the last number before their June meeting, and expect them to cut rates more than the Fed. So that's a macro tailwind. But we are also seeing, and we were talking about the Spanish data earlier and the two-speed economy, but we're seeing a bottoming out in the macro data in Europe, which investors are liking. And then earnings. Earnings have seen a significant upgrade in Europe over the past 12 months. It looks as though we've left that slump of the past few years. How fragile? Of course, European sentiment is not always very sustained, but it's certainly an area that has gathered a lot of momentum. Clients are looking at it in two ways. Going more selective, so looking at fundamental and systematic strategies like the ones we have at BlackRock, focused on finding quality that you don't really get in the index. So going active, selective, to find quality that the index doesn't really reflect. Or going early cycle in sectors like materials and industrials through sector ETFs to play that bottoming out in the cycle that we're seeing in the data.
When you're talking about the way you look at European equities in particular, I'm confused about the fact that there are it's a multinational market, and I would argue perhaps more so than even in the States.
Yeah.
Do you view it from that perspective, or do you view it from here's what's happening in the UK, here's what's happening in Europe, and you view it from a regional perspective?
Both, because obviously the UK...
You gotta pick one, Kareem.
Yeah. It's the
Even though it's your birthday.
Yeah. The economist answer of on one hand, on the other. But the UK is governed by different fundamentals. You've got a different fiscal policy, monetary policy. The BOE is potentially a bit more hawkish than the ECB in that they might not cut as quickly as the ECB and as fast. But continental Europe, we look at it regionally. You have a single currency, obviously driven by the same monetary policy, etc. But then you can also get granular and selective on countries.
Even with the FTSE, I'm going to zoom in on that.
Yeah.
The companies are still multinational companies. We talk about it all the time, that the way to play Europe is the catch-up trade to the States because so much of the exposure is in the States.
Fair.
So why is there that domestic read-through? Why is there even that currency read-through outside of the index level?
Yeah, so that's a very fair point. When you look at the index, for example, the FTSE 100 is 80% sales revenue from outside the UK. So the way to look at it in this multinational way is that you need to have a view on the global cycle when you're thinking about Europe and the UK, a bit more than you do on the US. So the US a lot more domestically focused in terms of sales revenue and economy. In Europe and in the UK, you need to be comfortable that the global cycle is in an uptrend, not a downtrend.
Are you comfortable with that?
We're starting to see that data bottom out, like in the manufacturing, in the hard part of the economic data of the economy. We're starting to see that bottoming out, which I think explains why we're seeing some of those ETF flows pick up into European equities and also into UK.
I'm going to quote my good friend and colleague Ed Harrison, who wrote a really nice piece on the Bloomberg Terminal talking about the fact that basically maybe we can just take the summer off and chill out because all of the catalysts this year are now going to probably become in the autumn, in the fall. We can park our money in cash. We can take the summer off and we can wait till then. You've got the US election coming up. The Fed's indicating that it needs to see a lot more data before it's going to make a decision on what it wants to do next. So the next few inflation prints, you could argue, are just evidence rather than actionable. And then we got an earnings season coming up at that period, which could be really interesting in terms of some of the trends we're seeing at the moment. Why don't I just put my money in cash, sit the summer out and wait for those big catalysts later on this year?
Well, put my money in cash implies I'm crystallizing, I'm selling out of the market, which implies that I know perfectly when to get back in.
Okay.
And that's a risk. It's a risk to time the market. That's why we always think of timing in the market as opposed to trying to time.
Okay, let me put the question a different way. Do I do anything with my portfolio over the summer? Let's assume you've got kind of you're sitting there, you're looking at your portfolio, you've made some gains. You don't want to. Do you? I come back to this question about catalysts. That is what I'm struggling to see over the summer. What are the catalysts that are going to make me think about changing my portfolio construction? Do you see any near-term catalysts that could force me to do so?
In terms of near-term catalysts, I think we've got the ECB meeting. So if we focus on Europe for a second,
we're going to assume we're going to cut rates,
meeting
right?
in June. Yeah, so that's we're going to assume they're going to cut rates. What's their forward guidance going to be? How is the market going to price that rate path forward after the rate cuts begin? I think it'll look a bit different, the world, after we've had the first rate cut. And also, we've got a few elections, certainly in the UK, also across emerging markets. So I wouldn't say there's a complete absence of catalysts to think about markets-wise. It's certainly less volatile, and we're seeing that in the implied volatility data of the equity market. It's dropped. And that's because of what you're saying, and that there's relatively less catalysts, but I wouldn't say no catalysts.
Great to see you, particularly on your birthday. Happy birthday.
Thank you.
Thanks for stopping by to see us. Karim Jadid, Head of EMEA Investment Strategy, joining us from BlackRock. Let's take a quick look at the core six across Europe to get an idea of what is happening here this morning. This is what the big picture looks like, nice and evenly split. Tech is definitely down this morning. ASML is down. Schneider's a little softer as well. It's interesting to see that Nestle is softening up a little bit as well. But Novo, LVMH and Ferrari all making gains. The tech sector absolutely front and centre when it comes to European stocks. Let's get more details on that read across from Salesforce with Joe Easton.
Said it there, Guy. Tech is one of the worst performing sectors today. A drop in SAP, a decent decline in that one, down 3.4%. Over in Germany, in the UK, we've got Sage and also a couple of the French companies, Dassault Systems and Capgemini, all down following this 16% drop in Salesforce yesterday, given that weak bookings number and also margins as well. This is the second worst performing sector today. I think miners very slightly lower than this sector, but tech clearly a weak spot. Lots of red on the screen, going the right way as we predicted before the open. Then we're going to look at renewables, that big deal for Neon. I didn't think we had a price on that. Currently, there it is. We've got a big unch on the screen, which means it's in a trading halt, which also means it's going to be a massive jump. We know it was around a 30% premium in terms of what Brookfield is paying for the stake in this company. They're in talks to do this deal, according to the latest report, confirming a Bloomberg exclusive. But we're seeing a read across in a couple of other solar stocks, Solaria, Energia and Acciona in Spain, and also EDP in Portugal, all of them getting a boost on expectations that we're going to see a big jump in the French company. We'll wait to get a price on that one. But it's not the only deal in the works. We've got a couple of others to bring you as well. We said earlier, Pirelli, there it is, down 5% as China's Silk Road Fund offloads around 500 million euros worth of stock, and the shares fall around 5%. It was priced at a discount. De La Rue, we're in the UK small caps, but this is the printer of UK banknotes announcing that they are in talks to sell a number of units. That was a surprise update in an RNS this morning, so that one is gaining. And Subsea, which is energy engineering, this is over in Norway, getting a massive contract over in Brazil, just outside of Rio de Janeiro, worth around $1.3 billion, and we're seeing that stock gaining at 3% today. There are some earnings and some decent share moves as well. Telecom Italia coming down. They reported some numbers. Jefferies was calling this one lower, saying that the equipment revenue wasn't as good as expected. We're seeing that coming down. Take a look at Auto Trader, up 11%. This is the UK website where you go on and sell your old used car if you want to. But it's also one of the UK's biggest tech companies now, and it's trading at a record high. It IPO'd in 2015, and it is at a record, the best performer on the Stock 600 today. Finally, a bit of a gain for Doc Martens. We all love our Doc Marten boots, don't we? And they've had a number of profit warnings. That one is coming up. Finally, a bit of relief there. And Frontline, we're over in shipping, oil shipping. It's had a good run given the spike in shipping rates, but it's coming down as they maintain their earning guidance, so potentially selling a bit of the fact on that one. There's a big note from Goldman Sachs on pharma stocks today, and they've got a couple of new buys. They're talking about innovation at Novo Nordisk and Novartis, the big oncology oncology cancer drug maker. They like the innovation at those companies. We know Novo, of course, over in the obesity space. Roche gets a sell rating from Goldman, though. They say that one doesn't have much upside. And Bayer, bit of a chemicals play as well. That's a neutral. So a big note on Goldman Sachs, on pharma. Keep an eye on that one on the terminal. Finally, we'll check in on Anglo American as this deal really does fade into history. We're seeing that coming down another 1.9% today. Bear in mind the BHP bid was worth around £31. We're only trading at 24 now. Jefferies downgraded it to whole. I'm hearing from traders that other analysts are downgrading to neutral as well. That one may keep falling as the morning progresses, Guy.
We'll keep an eye on that one. It's going to be interesting to see what the long-term trajectory, or maybe even the medium-term trajectory, looks like for this business in terms of it being a takeover target. Joe, thank you very much indeed. Theme of the morning, definitely that Salesforce read across. You're seeing that big time here in Europe. We're getting that after-hours shift lower, feeding through into Europe. We'll talk more of that in just a moment. I want to talk about what is happening with UBS as well. Some senior management juggling taking place at UBS. We'll talk about that next. This is Bloomberg. Where are we? 20 minutes into trade. This is what the market looks like this morning. As you can see, fairly flat, to be brutally honest. There's a big tech story, which we'll talk about more in just a moment, in terms of the implications of the Salesforce warning that we got last night and what it means for stocks like SAP. A fairly clear and stark read across already this morning. Let's talk about what's happening in the banking sector as well. I want to bring this story to your attention. UBS shaking up its executive team, in many ways paving the way for a two-way race to succeed CEO Sergio Mossi, who maybe isn't going anytime soon. But basically, this is what's happening. The head of the investment bank, Rob Karofsky, is going to jointly manage wealth alongside Iqbal Khan. Now, Iqbal's going east, Rob's going west. They're going to manage the US and Asia respectively. They're going to have joint responsibility, setting up a little bit of tension in terms of who the ultimate successor for Sergio Mossi is going to be. Let's get some more details on exactly what is happening here and what we can read into it. Miriam Balazou joins us out of Zurich. Miriam, let's just talk a little bit about the way that Mossi is setting this up and the kind of the tension he's trying to create between these two. What's the objective here? Is it ultimately who's going to step into his shoes?
It pretty much is, actually, Guy, because there was a bit of a clear path for Iqbal Khan all along. He was the heir apparent. He had the global wealth management empire, which is, UBS's bread and butter. But it's such a huge task and it's such a huge business to oversee alone, because previously he was co-managing it with Tom Naratil and then got sole ownership of it. But what's key in this global wealth management business really is the US, the business division in the US, because that's what's paramount. That's where UBS is sort of subscale. So this is where the strategy is going beyond the integration of Credit Suisse. This is going to be like kind of the core focus. And with this new appointment of Rob Karofsky, it will add a bit of tension, because it's no longer just Iqbal Khan, the heir apparent. You now have someone else of a similar caliber stepping in and also sharing this responsibility of growing this global wealth management powerhouse. Rob's American, overseeing the US makes also a lot of sense. He has the IB background, and what they've inherited from Credit Suisse is mainly the IB in the US, right? So it would be his job to kind of fold it in. So that's not an easy task, and that's a good task actually for Mossi to hand over to his potential successor. Yeah.
But what does this tell us about how long Sergio is going to be around for? Can I read anything in terms of the timeline here? I'm assuming that if we're going to set this competition up, it needs to run for a few years before we know ultimately who the winner is going to be.
Absolutely. There's still a bit of uncertainty as to when Sergio would step down. There's been different timeline laid out, but the latest he said that he would stay beyond the integration, because first of all, he wants to see through that integration, but also the strategy post-integration is the US, growing in the US. So he wants to see that this is, a well-oiled machine before he goes. And the latest, he said he would stay until 2027. So we still have time, but there's plenty to do, A, for the integration, and B, for the growth strategy in the US. So he's not leaving anytime soon, but it'll give him enough time to see who is the best place to replace him, really.
Well, Miriam, I think it's curious that, specifically in Asia, what the strategy actually is from UBS, given that if you look at some of its peers, they've been pulling out of Asia. You've seen fund flows exit Asia. You've seen layoffs across Asia. Morgan Stanley, I think, the most recent example. What is UBS's strategy in Asia?
UBS is still fully committed to Asia. And whilst we've seen other banks kind of pulling out, they've always been kind of adamant that APAC is one of their core business. They're doing really well there. Thanks to the acquisition of Credit Suisse, they actually won some market shares in other regions where it would have taken years to grow inorganically. So they're not going to let that go. And also, I think they're a lot more forward-looking in that sense that, of course, it's a bit of a rocky stage for Asia at the moment. But UBS looking long-term, and also they're looking at ultra-high net worth. They're not going anywhere. And so they just want to show also that they're committed to the region with this appointment of Iqbal.
All right, Bloomberg's Miriam Balesi, we thank you so much for that crucial context. Of course, we're going to keep an eye on it in terms of how all of that shakes out. We want to go from one of the biggest names in banking to one of the biggest names in tech. Really check back in on that Salesforce read-through. This was top of mind for you this morning.
Yeah, absolutely. The first thing I saw this morning was this warning, and you're instantly thinking about what it's going to mean for SAP in particular, which has had a really solid stock run recently. And if you're starting to see cracks appearing in enterprise software, I think there's two ways of reading it. A, you kind of look at the initial read across into some of the stocks we've got up on the screen for you. But then I think you've got to think about, why is this happening? What is going on behind the scenes that maybe customers are not ready to commit to an increase in spending? Is it just a headcount story that a lot of these companies are not, the customer companies are not increasing their headcount, so there's not the requirement for some of the software? I think there's a few layers to peel here.
Well, to your point, this is an ongoing story. You can see it on the Bloomberg terminal on the chart we're showing right now. This has been a several quarter story. This isn't coming out of the blue. You mentioned the AI story. I'm curious about, is this the kind of macro indicator? When you start to see your big corporates pull out a little bit, is that indication that, okay, well, this economic cycle may not be as strong, as resilient as we tend to think it is?
Yep. We certainly got maybe the impression of that from the Beige Book yesterday. We're going to get more on what is happening with the global economy. Janet Henry is going to be joining us on HSBC next. This is Bloomberg.
This is Markets Today. We're about 30 minutes into the European trading day, seeing a little bit of a pullback, slight pullback, I should say, in the stock market. It looks like it paired some of those losses, but something we're going to be keeping an eye on. Healthcare, the standout performer. The rest, trading a little bit on the back foot. That's what's going on in the markets. Let's talk about the economics. Bloomberg has learned that the ECB is set to impose unprecedented fines on lenders for failing to address the impact of climate change. Let's bring in our European correspondent. Bloomberg's Oliver Crook is all over the story. Ollie, for the ECB, is it now the European Climate Bank?
Well, maybe it is, Kriti. So listen, this is part of their expanded mandate as a regulator, looking at basically how climate change could affect banks, and are banks taking enough provisions in order to deal with some of those concerns? You may then ask, what possible impact will climate change have on banks? And the answer to that is it's a pretty wide sort of set of metrics that they're looking at. They're looking at how it could affect some of their clients, how it could affect some of their assets, if they have loans, say, to large fossil fuel companies and you have sort of regulation that changes, or maybe you move towards more renewable energy. These are all sort of very vast ways in which it could happen. So we understand that there's going to be potentially a fine imposed on up to 4 banks. The sum itself may not be that huge. It could be just more symbolic. But I think the more sort of telling point is this sort of, when we step back and think about the ECB and the divergence with the Fed, it's not just rates. It's also in regulation. The Fed has been very sort of soft-spoken on anything to do with sort of climate change. And it really brings up the question about the competitive disadvantage potentially for a lot of the European banks when thinking about competing against the U.S. banks. Is this just another example of that? We had Macron this week speaking in Germany, saying that basically in Europe, the big problem we have here is we need to innovate first and regulate second.
Yes, that would be nice from Europe. That would be maybe a little bit of a change in tack, certainly from what we've seen in the past. Ollie, let's turn our attention. We're going to kind of jump around a little bit here. I want to talk about what's happening in the bond markets and the size and scale of the sales that we are seeing. In America, in the US, we're starting to get nervous about the scale of the issuance that is happening. Talk me through what is happening on this side of the Atlantic.
Yeah, so what we got yesterday was basically a record in terms of how early in the year €1 trillion worth of bonds had been sort of issued in Europe, right? This is across sovereign and corporate, and there's a couple of reasons for that. The last time, by the way, it happened was on June 9th, 2020. Let's think about what was going on June 9th, 2020. We're in the beginning of the pandemic. Companies and sovereigns were battening up the hatches with debt. And don't forget, interest rates were negative. And now you're going into a world where you have very high interest rates in a comparative basis, issuing a huge volume of debt. Part of the reason that that's happening is a lot of the corporates who have the ability to would prefer to issue them in Europe because comparatively, rates are going to come down earlier and it's going to be a more favorable sort of rate environment. But there's also the question of the sovereign debt guy with mounting burdens across Europe, whether it's France, whether it's Italy, and sort of hitting into the sort of the big issues that Europe needs to deal with. First, sort of defense spending, and second, maybe climate priorities. And this will all sort of come to sharper relief next week when all of the decisions of where that money is going to be spent, of which there is perhaps a little bit less headroom to do, will be determined in part by the European elections, which kick off just next week.
All right, Ollie, in our continuation of random ECB topics we're putting all together, talk to us about the inflation data that's out today. We're already getting 24 hours of two very different stories out of Germany and Spain.
Yeah, so listen, Germany and Spain, they both, the kind of year-on-year figure came out a little higher than had been anticipated. It's also moving in the wrong direction, right? There were two prints in Germany going higher. We've also seen the sort of slowdown in core abate a little bit, so there's a little bit of concern there probably from the ECB. But we've had a lot of commentary from ECB speakers over the last few days. Nagel said the second cut probably after June would have to come sort of September. But what I was really struck by in a lot of the commentary from the ECB is that they're really sort of reticent to give any kind of forward guidance, saying that we're really going data dependent, meeting to meeting. I think generally speaking for the ECB, they believe that the sort of inflation narrative is intact. The question is the speed at which it's coming down and will it stick and stay at that lower level? And that is why I think they're going to be a little bit more reticent to give guidance. The sort of lone dove there is Villeroy, which has said don't rule out a July cut.
It's going to be an interesting debate around the table. Certainly, we'll look forward to the coverage of that. Ollie, thanks for joining the dots for us this morning. Ollie Crook joining us out of Berlin. Janet Henry is the global chief economist at HSBC. She's sitting next to me, perfect person to talk to. Janet, are we still overestimating the need for cuts, the cuts that are coming? We've talked a lot about the Fed, but elsewhere in the world as well. The global economy, certainly the European economy, the US economy, they don't feel like they're slowing down to the same degree that maybe people had anticipated. And that in some ways, by extension, maybe it gives us the idea that inflation won't come down maybe as far as we had anticipated.
Well, as you say, the story is very, very complex. The US, relative to the second half of last year, is slowing a bit, but you've got some parts of the economy accelerating, some parts slowing down. But Europe is particularly interesting in this regard because most of Europe was actually in some kind of recession in the second half of last year. And with inflation coming down and expectation of lower rates feeding through, you've actually seen some green shoots at the start of the year. The world, there's a lot going on, there's a lot of risks in the global economy, but despite all of that, there has been some gradual improvement. But we always knew that the inflation story was going to be uneven from here. The easy bits were over, the energy story, the supply shock story. We've now got some supply shocks re-emerging to some degree. Energy isn't detracting, and yet they've still got time on their hands, but the ECB still wants to cut.
It does want to cut, but does it need to be cautious? There's this idea that we're kind of putting in a June cut, a July cut, potentially a September cut. We're hearing certainly from a lot of Fed speakers at the moment, they want to wait and see. To what extent does that apply, or should that apply, to the ECB as well?
Less so. You've got a stronger demand story in the US, and I think also the supply side of the economy with labour markets and immigration and so on is much more supportive of US growth. I think as far as the Eurozone is concerned, it is quite clear from the commentary from ECB members that they do believe that the inflation narrative is in play. Now, they've absolutely said we are going to cut in June. Irrespective of anything that happens, we're going to cut in June. But I think as we go into the press conference next week, it will be one of those painful ones where every single reporter says, and what about after June? What about
what would you ask then?
I would ask more about their confidence in their inflation narrative, because I suspect they'll revise up growth, they'll revise up inflation, and they will try not to give anything away. They won't rule out July, but they will use the Fed speak to some degree. We need more confidence. We've got time in our hands. The economy's recovering.
What kind of difference does that make, though? A second consecutive rate cut versus, say, pushing it out to September?
A lot depends on the context with which it is happening.
Well, now you're sounding like an ECB official.
But it is, because actually, there is a lot going on in the world.
Yeah.
China's a very complex story. Even what happens in Japan is very dependent on what is happening in terms of the global narrative. Because if the US does continue to surprise on the upside, and you get some kind of continuation of what seems to be quite a synchronized improvement, that increases the likelihood that the Bank of Japan will do more. It's not just the ECB. And I do think there's a limit on the extent to which the Fed and the ECB can decouple. We still think the Fed will cut once this year. In that context, the ECB can cut 3 times. But if, actually we have a very different picture in the US, then I think the ECB will deliver less in terms of...
I feel like I've been going around the houses on this debate for quite some time.
Yes.
The new piece that increasingly feels like it's inserting itself into this debate is what is happening with the US fiscal deficit. And you've started to see auctions over the last couple of days become a little more of a struggle. If it becomes even more of a struggle from here and it's actually demand for bonds that pushes yields higher, how will that change the calculation, do you think, for some of these central banks? And how big a problem could it become?
Well, I think, at the margin, one of the reasons the ECB wants to cut rates is because they do think policy is restrictive, and I think they are more united that policy is restrictive, and by making it a bit less restrictive, credit markets will ease a bit, and maybe sovereign pressures will ease a bit. As far as the US is concerned, Powell has been quite clear. He thinks that the US public finances are unsustainable.
Yeah.
But even when you know something's unsustainable, you don't know at what point it becomes a problem. And it's not that you won't sell US Treasuries, but there might be a higher risk premium, but maybe that comes with the elections and happens next year.
Do I need to insert Liz Truss into this conversation?
She is a reminder of what can go wrong if you do not have a plan for long-term fiscal consolidation and if you deliver tax cuts that are not going to be funded. So, yes, it is a reminder of what can go wrong. But the UK is not the world's reserve currency. You can actually be the world's reserve currency and run what are extraordinarily large budget deficits, arguably for longer, in the US.
I was going to say, you're talking about Liz Truss, and it sounded very familiar with the U.S. dynamic. I was going to ask you about recession, but let's talk about the deficit first. How do you hedge it? It's happening in less than 12 months, where we hit that deadline in January of 2025. I mean, what happens? What is the worst-case scenario? How does it play out?
There is still a market out there. I do go all over the world. I talk to investors. And some investors are reassuring themselves that during the first Trump administration, the equity market rallied. He inherited a strong economy. He delivered tax cuts. He delivered, especially for the corporate sector as well as high earners. And the equity market rallied. Other investors are much more cautious, but they find it very difficult to make an investment decision based on a specific outcome. So it does just lead to some diversification in their portfolios.
But on the debt ceiling story in particular, 2011 is kind of the only roadmap we have in terms of a credit rating change. But I'm curious in terms of the rest of the world, there's still, even if the United States isn't able to balance their books or whatever that is, what happens? It kind of feels like there's still no safer place than the dollar right now, given the monetary policy environment, given the election risk. And even in the bond market, Treasuries are still the safest place, even when the U.S. government can't balance their books. Am I wrong?
Yeah, you're absolutely right. I mean, we've had the familiar discussions for some time now, haven't we, about, what is the long-term equilibrium rate? What is the U.S. going to be paying on this extraordinarily large budget deficit and a debt stock that, in the coming years will be on par with Italy's, but it is still the world's reserve currency.
Yes, that chart making its way around, isn't it?
But there is that standard crowding out issue. There will, at the margin, if interest rates are higher in the U.S. for the public public sector, that will impact on certain parts of the private sector and on emerging economies, particularly those that are dependent on foreign inflows. They are going to face the higher funding costs. And even if they don't have a crisis, then that too will mean a tighter monetary environment and lower growth in those economies as well.
You're back from China. Are we starting to see momentum? Is the economy... Is what they're trying to do with the housing market going to have an effect? Is it enough to have an effect? Just talk me through what you kind of picked up, because everybody's kind of curious to get a sense of what is happening there and whether or not this does have the momentum, enough momentum to kind of regain critical velocity for that economy.
I think there's still an awareness in China of what they call the three mountains.
Yep.
The local government debt, the shadow banks, but in particular the property sector. And they are structural issues that will play out over a period of many years. And we do need to bear in mind that the policy decisions over the last 2 or 3 years, compared to China's history and compared to the US and Europe, has been really incremental, but it is getting bigger. And actually, we think some of the more recent measures will start to absorb some of the supply. But we are seeing some growth areas. Obviously, consumer services to some degree, but savings rates are still high because there's that unemployment uncertainty. But anything to do with semiconductors and other areas of industry like defence are doing remarkably well. So, we haven't changed our growth forecast this year. I saw the IMF just revised up. But, we were already at the higher end, I guess, of growth rate of 4.5% this year. So, you've still got the three mountains playing out, but there's areas of cyclical improvement, and that policy stimulus should feed through into a more sustainable improvement.
All right, I've got to ask the recession question now. It's been a while since I think people have really talked about the potential of recession. It feels like a kind of contrarian thought. How quickly do things go wrong, though, especially on a day like today where a lot of people are talking about cracks in private credit, a deficit
this is a
that's
US
coming.
recession, right?
Or
a global recession.
I'm talking about a global recession, because if you talk about a U.S. recession, doesn't the rest of the world kind of follow suit? If the U.S. catches a cold, it's the rest of the world. Whatever the phrase is, I can't remember.
The U.S. sneezes, the rest of the world catches a cold.
That's the one. Close enough. Is a recession conversation still relevant? Because it feels like history proves that slowdowns, recessions, they don't happen gradually. They happen very quickly and snap.
Well, I guess in recent decades, whenever you see a sustained increase in interest rates, the story has been the Fed raises rates until something breaks. Then you get a recession, and then you get a collapse in interest rates. The point that I've been making over the course of the last 3 years, because you may recall we've never been in the recession camp. We've always said this is a very different cycle. And it has proven to be. This is incredibly protracted. We still don't have inflation back at target in the US by the end of 2025. So it is, you're right, it's not something anyone is talking about. At one point, even the Fed was talking about a US recession. They are not. That's what will be the real surprise if it happened. But the difficulty with the US, enormous distributional differences. On average, everything looks kind of fine. Cash holdings are high. And the household balance sheet in total, great, because anyone that's not reliant on credit is doing well. But you are seeing a little bit more in terms of strain feeding through. People reliant on variable rates in terms of the corporate sector, the household sector, delinquencies, not just in the youngest age groups, but those people aged 30 to 40. That's not back at pre-financial crisis levels, but it's certainly on the way there.
You say you're not in the recession camp, and you haven't been for about 3 years. This is a very different cycle. I appreciate all of that. We're, at the end of the day, still in a capitalist system on both sides of the Atlantic. That means a recession has to come eventually. What does that look like to you? Are we years away from that? A decade away?
It may not look the same as those in the past because we've got this very different structure in terms of labour markets. And some of that is a legacy of the pandemic. We've seen that particularly in the UK with the rise in long-term sick. But a lot of it's demographic. And actually, partly in Europe, where investment spending has been quite weak for quite a long time, actually it's been a very, very job-rich recovery. Look at Germany last year, quite a significant recession. Unemployment barely rose, and actually employment continued to grow. So your typical recession is one that delivers a very big rise in unemployment. We're looking for a in fact, the Fed isn't looking for one at all. We've actually got a slightly bigger rise in unemployment over the next year in the US. But again, that's complicated by the immigration story, and it's also complicated by the potential change that might occur in the US in the coming year.
All right, Janet Henry, we could talk for hours with you, but we thank you so much for making time for us this morning. Global Chief Economist over at HSBC. Coming up on the program, South Africa's rand weakens after forecasts show a marked decline in support for the ruling ANC party. We're going to bring you the latest on the election and the market impact. Stick with us. This is Bloomberg.
From all aspects of the economy, overarching that the slowdown and the low growth trap is really inhibiting benefits to most economic sectors and households. And I think there has to be a deliberate and a very decisive economic strategy that is put in place by the new administration to change this.
We have about over 30% unemployment rate, and the majority of people who are unemployed are women, and specifically also young women.
We really need some fresh blood to come into the cabinet in order to firstly fast track the reforms that have been implemented, but also come up with new ideas, because from a growth perspective, so much still needs to be done.
Some of our guests this week on why the reform in the South African economy is the key issue for whoever ends up elected to the government. In the meantime, the rand has weakened after early forecasts show South Africa's ANC party is at risk of losing its parliamentary majority for the first time since taking power 3 decades ago. Let's get the latest from Bloomberg's Jennifer Sabasaja joining us from Johannesburg this morning. Jen, walk us through these projections.
Yeah, Kriti, I mean, this is a fast-moving story, as you can anticipate. So right now, you were just mentioning that model. It's important to note what it actually is. It's from the Council for Scientific and Industrial Research, or CSIR, and it is a government agency, has a 2% margin of error, and in the past has been quite accurate. And so what it is showing, as you were mentioning, ANC right now, based on the votes cast, is on course to win 42% of the vote in Wednesday's national election. And that is right now, we're just at about just over 12% of voting districts that are counted, which is important to note. And as you mentioned, this would potentially, if this continues, would be the first time that the ANC does not get this majority, and potentially could be the reason why we are seeing the reaction in the dollar, or in the rand, excuse me. The model is also showing some interesting stats. It shows the main opposition party, the Democratic Alliance, likely to win just over 22% of the vote nationally. The EFF, which we've been speaking about quite a bit, just over 9%, and former President Jacob Zuma's party just over 12%. And so, as I mentioned, you know, it's still relatively early, but clearly having an impact on investor sentiment.
OK, let's talk about that investor sentiment, Jen. Why is the possibility of a coalition making investors nervous?
Right. So, Guy, we had been talking about this leading up to the election, and it really was not the base case scenario that we would potentially see the ANC dip below the 50%. And that is because, really, if we look at the local level across South Africa, coalition governments have been quite unstable. And so investors were a little bit jittery about if this were to happen, that the ANC gets below this threshold, they're going to have to partner with some of the smaller opposition parties, not necessarily the main opposition party, the Democratic Alliance, which is a bit more market friendly. And so that really is part of the reason why we are seeing the rand down weakening by as much as 1.6% against the dollar. We're also seeing the Johannesburg Stock Exchange tumble. And it just seems like the volatility may continue until we get a bit more clarity whether or not the ANC, or where the ANC falls in terms of their percentage of support. But then also, what does a coalition potentially look like? If it is one of the smaller parties like the EFF, they may demand or ask for more say over the economy, potentially ministerial positions. And so it seems like investors are watching quite closely as to what this could actually mean moving forward.
Okay. Jen, thanks very much indeed. Jennifer Sabasaja joining us out of Joburg, Santon, on the election results. We're going to continue to keep you up to speed with exactly what those numbers are looking like. The early indications are looking increasingly like the ANC since the mid-90s, this is the party that has ruled, may actually be about to lose that majority. Let's turn to another story we're going to be watching over the next couple of days. But actually, Kriti, it takes me back to the story yesterday, which was fairly dominant in the United States. It's not the bond market, it's what's happening with American Airlines. American Airlines stock down really sharply yesterday. There's a bunch of things happening within American that are causing problems in terms of its revenue guidance, which it's dropped quite significantly. And the market's trying to figure out whether or not this is an American issue or whether this is a broader demand story.
Yeah.
And what I'm hoping is over the next few days, I'm going to Dubai. We're going to figure this out because the IATA AGM, which is the industry body, they're all gathering in Dubai. I'm going to be there. We've got a great team lined up there as well. And the critical question I think we're trying to figure out is demand beginning to soften? Because if demand in the airline sector is beginning to soften, I think that's quite an interesting tell on what's happening with the consumer.
It absolutely is. This is the same conversation we had with Salesforce as well. I thought what was interesting about American Airlines is they said there's still record demand. They're still expecting record airfare, record demand for at least the summer session. It's the capacity question that seems to be a bigger deal. They have higher costs as well that they have to deal with.
Issue,
wages have been more of an issue in the States than I would argue that they have been here in terms of negotiations with pilots, flight attendants, etc. We haven't even talked about the jet fuel issue. I haven't looked at jet fuel pricing lately.
Jet fuel prices have been coming down a little bit, and US airlines are less hedged than maybe some of their European counterparts.
Yeah.
But I think the interesting thing was that what they were talking about was that they'd shifted their model. They wanted a more direct relationship between corporates, consumers, and American, and that's been where the real struggle has been. So is it just an American issue? Have they been ceding ground to Delta? Have they been ceding ground to United? And can they quickly claw that back? Yeah. But it speaks to the idea as well that what we're seeing here in Europe, Michael O'Leary over at Ryanair has been talking about the fact that actually the summer's not going to look as strong as maybe he had first anticipated.
From a market reaction, though, we saw that read through in yesterday's session. IAG down very, very big. Lufthansa down very, very big. Air France as well. Today, you're seeing a rebound in the stock, in all the stocks. And I feel like that's just a little bit of recovery and pairing some of the losses that you see. But tell us about the guests that you're going to have.
So we've got some great guests lined up. In fact, we're going to be speaking to most of the major players. We're not going to be speaking to American, but we are speaking to most of the other major players that are out there. So I'm talking about Bastian tomorrow. Tim Clark's going to be joining us. He's the host in Dubai. We're going to be talking to Pegasus, the low-cost sector. Shai's going to join us from Virgin. We've got Scott joining us from United and Ben Smith from Air France KLM. It's a great lineup over the next few days. We are going to find out the answer to that demand question, I assure you.
So guys hopping on a plane right after the show. We're very excited for that coverage. We're not going to see each other for a little bit. Coming up, of course, next on The Pulse, though, and also a great lineup. You've got the SocGen chairman at 9 a.m. UK time, plus someone out of the British Chambers of Commerce. This is Bloomberg.